It's been a psychic challenge to decide how to feel about USAID. And you've quoted people from the school of thought. You've quoted the book Aid is Imperialism by Teresa Hayter. She's explained how foreign aid is used as a tool for economic and political control. There's a book, The Self-Deception Trap. Carlos Lopez talks about how European countries have used aid to establish dominance over countries in Africa. There's another book, The Washington Bullets by Vijay Prashad, where he actually quotes the Greek Minister of Finance, Yanis Varoufakis, who, when he was confronted by the European Union and the IMF during the debt crisis in Greece, he said, coups in the current period do not necessarily come through tanks, they often come through banks. And this has been a common tactic even in the US. Richard Nixon notoriously told Henry Kissinger to make the Chilean economy scream to prevent the rise of Salvador Allende. And along with coups by banks, Vijay Prashad has also pointed out the role of coups by NGOs. And he's used the example of Haiti and how the US has established NGOs all over the country to establish dominance. So I hear you. It's so tough to come to terms with aid being used as a facade or a mask for imperialism, but there's also obviously some positive externality that you have also pointed out. It's tough to come to terms with it. I want to zoom in on one aspect of the coups by banks. What causes these debt crises in the country? Is it true that a lot of the debt in these developing countries is actually engendered by these donor countries itself? Are those the reasons why these countries actually require aid in the first place?
So there is a fundamental structural imbalance for developing countries. That is, they're much more likely to have trade deficits and balance of payments deficits. Okay, they're industrializing. They need to import a whole range of goods. Even if they want to diversify their economies and start making those goods themselves, they will need to import machinery, they'll need to import intermediate goods, and they will not necessarily have enough exports to cover that. So there is a structural tendency to balance the payments deficits. It's something Keynes recognized as well, right? So when Keynes was planning for the global monetary system and financial system during the Bretton Woods era, what he wanted was a system whereby you would have a global currency, the Bancor. I suppose the SDR is a sort of half-hearted attempt to try and provide that. But the Bancor would be something just created by this institution, which he called the International Clearing Union. And it would issue these Bancors to every country according to a ratio of, let's say, the share of the global economy, the size of the population, etc., some formula. But developing countries would get double of that share because of that structural deficit, because of the fact that systemically they're much more likely to run balance of payments deficits. So they needed access to foreign exchange. Now, this is a painless way of distributing it. No rich country is getting affected, right? Because it's all money, just liquidity being created. That didn't work. That didn't fly, unfortunately. And so what we've got is a system where when countries enter into deficits, the IMF, which is supposed to provide short-term liquidity, and the World Bank, which is supposed to provide the longer-term financing for industrialization, for economic transformation, etc., have both failed. They have been inadequate, they have been slow, they have been conditional, they've insisted on all kinds of conditionalities that end up undoing any of the possible benefits of whatever little money may come in. And they have largely operated in the interests of global finance and large private capital globally. So the Bretton Woods institutions have really been a big disappointment. They have not lived up to their initial goals or even what is stated in their memorandum of agreement. They are really now, unfortunately, not delivering at all because they are largely serving the interests of the rich countries and global finance. It's not surprising because the way they were constructed, the US has got effective veto in both institutions. You need an 85% voting majority for most major decisions. And the US has got 16% votes. So just above that, you will never get there without the US, even if all the other countries in the world combine. But the US and Europe and Japan and Australia, etc., the rich countries together have got like 60% of voting rights. So there's no way developing countries would actually be able to get those institutions to deliver the way they were meant to. Effectively, the borrowers have no rights. So that's one problem, which is that the institutions that were set up in the middle of the 20th century to deal with this problem of inadequate finance reaching developing countries, they didn't do their job. As a result, private finance has become much more significant. Now, until fairly recently, until the period of globalization, developing countries, most of them didn't even have access to global private finance. They could not really get into private capital markets because they were seen that nobody wanted to lend to them. Everybody would lend, buy US Treasury bills or lend to other agents in the rich countries or some of the middle income countries. Very little did they get access to credit. So, in fact, when they had balance of payments crisis, IMF, World Bank were the only things they could turn to. And then, with all of those attendant conditions and so on. What changed in the period of globalization, in fact, it wasn't really even in the period of globalization, but subsequently, is that you got a period of very easy interest rates. You got easy money policy in the US beginning in the 1990s. And then you got a dramatic expansion of liquidity in the 2000s, especially after the global financial crisis. So you're beginning with easier liquidity, and you're encouraging more and more developing countries to open up their financial markets, to enable domestic companies and governments to borrow more, saying, well, look, you can now borrow abroad. Earlier, capital markets wouldn't even let you in. Now they're willing to lend to you, so you must borrow. After 2008, the big financial crisis, you had massive monetary easing. You had the US, the European Central Bank, Japanese Central Bank, just throwing money out there, just absolutely flooding the world with liquidity and very, very low interest rates, right? Less than 1%, sometimes even in Japan and a few countries in Europe, even negative interest rates over some periods. And there's all this money now sloshing around the globe looking for a place to put it. So you had not just what are called emerging markets. Emerging markets are the countries, the developing countries which are earlier not seen as bankable, but now they are seen. So now they were integrated, right? And that happens in the 2000s. But by the 2010s, you've got the frontier markets. Now, the frontier markets are the ones that were seen as absolutely beyond the pale, zero access. Now, even they are getting access, okay? Now, remember, they're getting access, but there's still a risk premium. That is, they say, oh, well, we're lending to Zambia, or we're lending to Costa Rica, we're lending to some other country. It's going to be more expensive for them to borrow because they are not our top priority borrowers. Okay, they're not our AAA borrowers, if you like. So they did get access, but at much higher interest rates. And if anything happens, any shock happens, and the shock can be something that has nothing to do with your own country, then there would be a capital flight and the cost of borrowing would shoot up. And a lot of the lenders who had given money to you would suddenly stop lending. So we've had phases of these debt crises. We had the early 1980s and, the debt crisis, which really hit Latin America most, but there were other countries as well, South Korea and a few other African countries that were affected. That was not due to what the Latin Americans were doing. That was due to Reagan coming in, tightening money supply, raising interest rates. And so all the money flooded back to the US. So they were suddenly caught in the middle of their borrowing. You borrowed for something long-term, but it's because of the fact that you're seen as high risk, etc., you're rolling over these loans at rates that are getting higher and higher. But then if the interest rate in the US has gone up, the capital's just gone back. And you don't anymore have that, the access to the funds you had when your investment is only half done. So even if you were doing something perfectly good and required with that money, suddenly you find you don't have it. So you have a debt crisis. So we've had the 1980s debt crisis. Then we had the Southeast Asian debt crisis in the 1990s, 97, 98. Similar pattern. Again, it was not something that happened that these countries did. What happened in Southeast Asia is that China emerges as a major exporter. How in 1994 they devalue their currency, the renminbi, okay, quite significantly. And suddenly they're starting to export a lot of the things that Southeast Asians were exporting. And so these Southeast Asian countries that were showing export growth rates of 15%, 20%, I mean, crazy. Suddenly they're down to zero. Suddenly exports are flat. And so the capital, which had been put into these countries, And remember, for major financial institutions, it's a tiny amount. It's huge for the countries, but it's a tiny amount for them. So they just shift their portfolio. They say, let's move out of Thailand, let's move out of the Philippines, let's move out of Indonesia. And there's a big swing. So you have a big debt crisis there. Africa, similar. The mineral exporting countries, they would get money because they say, oh yeah, they've got iron ore, they've got cobalt, they've got copper, they've got whatever. Copper price falls, bam, they get a double whammy. Not only does their export price fall, but the money that was coming into them stops. So that's why you have these periodic waves of debt crisis in developing countries. What's made it particularly worse in the current situation is that, earlier you would borrow from, let's say, there would be some public borrowing, and there would be some multilateral borrowing, and there would be borrowing from, let's say, banks, in terms of basic loans. Increasingly, from the mid to 2010s, we've had bond markets developing for all of these countries. And this was encouraged by the IMF, by the World Bank, by the Davos people in the World Economic Forum. Countries were told, of course, you must have your own bond markets. Of course, you must issue bonds because you're going to get access to all of this money. And they were actually encouraged to get sovereign bonds. The governments were encouraged to issue debt abroad for their own fiscal deficits, which, when you think about it, is a very stupid thing for an IMF that is supposedly concerned with balance of payment stabilization to be advocating. But they actively did that. And so you find that many, many countries were attracted to this because really low interest rates, right? I mean, crazy low interest rates, well below the rate of inflation. So negative rates in real terms, and access to money of a kind that you simply didn't have before. So some countries used it and took it and used it badly. The Rajapakshas in Sri Lanka, for example, they had vanity projects, they had corruption, they had the works, okay? They took it and misused it. But you have countries like Zambia that were trying to invest in infrastructure, that were trying to do good things to diversify their economy. But they also get caught in this simply because you've taken all these loans and you're anticipating that you'll continue to be getting these loans for a reasonable amount of time until you finish at least that investment. But meanwhile, first COVID happens, the COVID-19 pandemic, and then the Ukraine war happens, and inflation comes along with that, and then the US and EU decide to raise interest rates. So again, multiple whammy. Your export earnings fall, your other foreign exchange earnings fall, and you stop getting the capital flows. And the interest rates on your debt go up. So it's not surprising that so many countries ended up in extreme debt difficulty. 72 countries were in severe debt stress. About 11 of them were in default. It's a little lower now, but that's not because the problem has got easier. It's because they have managed to squeeze out that payment, those debt repayments, by squeezing their own populations, by denying them consumption, denying them basic public services, and so on. So there is a deep sense in which the workings of the international financial system and the fact that there is this currency hierarchy are really deeply against the interests of developing countries. And I would argue that for many of these countries, you should minimize your external debt dependence. You should not be saying, oh, the interest rates are cheaper, I will just borrow abroad. You should only borrow for the things that you desperately need the foreign exchange for. And everywhere else, you actually try and use other methods, and you use domestic resources. You raise tax revenues, including through a wealth tax. You wait for, or you use domestic borrowing, which is actually at least in your own currency. So you're not stuck, in a way that you have to go to the IMF.